Imagine working an 8-hour shift on Monday, clocking out and needing $50 that exact evening for an unexpected car repair or a prescription. Traditionally, you'd have to wait 2 weeks for payday, forcing you to choose between skipping an essential expense, incurring a bank overdraft fee, or turning to high-interest payday loans. That gap between when you earn your money and when you actually get paid is where earned wage access services, like DailyPay, come in. DailyPay promises to eliminate the biweekly waiting game by giving hourly workers access to their wages as soon as they earn them. On paper, it sounds like the ultimate financial lifesaver. But is on-demand pay actually a path to financial freedom, or does it create a new cycle of financial dependency? To understand how DailyPay impacts hourly workers, you first have to understand how the traditional pay cycle works and why it creates so much stress. For decades, the standard corporate payroll system has run on a weekly, biweekly, or semi-monthly schedule. Employers hold onto your earned money for 2 weeks to process taxes, benefits, and administrative paperwork. But life doesn't operate on a 2-week delay. Rent, groceries, utility bills, and emergency expenses happen every single day. For millions of hourly workers living paycheck to paycheck, a minor unexpected expense mid-cycle can trigger a domino effect of overdraft charges, late payment fees, and massive financial anxiety. DailyPay operates as a middleman between you and your employer's payroll system. Every hour you work is logged, calculated, and placed into an available balance on the app. If you earn $120 today, a portion of that money becomes accessible almost immediately. You can transfer that money straight to your bank account or a debit card. At the end of the regular pay period, your employer pays DailyPay back for whatever amount you accessed early, and the remainder of your paycheck is deposited into your bank account as usual. It's crucial to understand that DailyPay is not a loan. Because you're accessing money you have already worked for, there are no credit checks, no interest rates, and no impact on your credit score. That distinction is why many employers promote DailyPay as a wellness benefit designed to help workers avoid predatory lenders. However, the real question isn't just how DailyPay works, but how it alters your financial habits. And this is where the deeper fears and risks begin to emerge. The biggest fear surrounding on-demand pay is the trap of habituation. When you pull money out of your paycheck early, your upcoming official paycheck gets smaller. If you withdraw $200 during week 1 of a 2-week pay period, your actual payday check will be short by $200 plus any transfer fees you incurred. If your budget was already tight, receiving a reduced paycheck on payday almost guarantees that you will run short on cash again during the next cycle. This forces you to rely on DailyPay once more, creating a continuous loop of drawing from tomorrow's work just to pay for today. Another hidden aspect workers often overlook is the fee structure. While standard ACH transfers that take 2 to 3 business days are usually free, instant transfers often carry a fee, typically ranging around $2.99 per transaction. On the surface, $3 sounds negligible. But if an hourly worker transfers money instantly 4 times a month, that's nearly $12 in fees. If you're transferring small amounts, say $30 at a time, paying $3 to get $30 instantly is equivalent to paying a 10% fee. Do that repeatedly, and the annual percentage cost rivals traditional short-term credit options. There is also a psychological shift that happens when the boundary between work and immediate payout disappears. A traditional payday forces natural discipline. You learn to stretch a fixed amount of money over 14 days. When income becomes instant, spending can easily become frictionless. It's easy to treat earned wage access as an everyday digital wallet rather than a safety valve, making long-term saving and structured budgeting much harder to maintain. So, how should hourly workers view and navigate DailyPay? Is it a tool to embrace or avoid? The truth is that DailyPay is neither inherently good nor inherently bad. It is a tool whose value depends entirely on how you use it. When used intentionally, it can save you hundreds of dollars in overdraft fees or high-interest credit card debt. But to keep it from working against you, you need clear guardrails. First, treat DailyPay strictly as an emergency buffer, not a primary budgeting strategy. An emergency is an unpredictable, essential expense, like an unexpected medical copay or a tire replacement required to get to work. DailyPay should not be used for routine leisure, dining out, or impulse purchases. Second, if you do need to use the service, opt for standard transfers whenever possible to avoid instant fee charges. If an emergency requires an instant transfer, factor that fee into your math and keep track of how many times you hit the transfer button each month. Third, rebuild your pay cycle rhythm. If you find yourself drawing from DailyPay every single week, take a step back and map out your baseline monthly expenses. Identify the fixed costs like rent, utilities, and transportation that must be covered on payday before any discretionary spending occurs. The ultimate goal should be to build a small, independent emergency fund, even just $200 to $500 in a separate savings account, so that over time, you rely less on early wage transfers and more on your own cash reserve. DailyPay offers hourly workers unprecedented control over when they access their hard-earned money. It breaks a rigid, outdated payroll schedule and provides a crucial cushion against unexpected financial shocks. But control requires discipline. By understanding the mechanics, monitoring the fees, and reserving on-demand pay for true emergencies, you can harness the benefits of immediate liquidity without falling into the trap of endless payday recycling.